Hello everyone. Our topic for today is types of debt funds. In this video, we will learn what are the different types of debt funds available for investors. But before moving on to the types of debt funds, let us first understand what is debt. Debt is a simple word. There is a lender who has excess money and there is a borrower who is in need of money. The lender lends money to the borrower for a fixed interest and for a fixed time. For example, let us assume there are two friends, Sonu and Monu. Monu was in need of 1000 rupees because he wanted to buy a book. Sonu has excess 1000 rupees. So, Sonu lends rupees 1000 to Monu with a promise from Monu that he will pay 100 rupees extra along with 1000 rupees after 1 year. So, this is a debt situation. Here, 1000 rupees is principal, 100 rupees is interest and 1 year is time. Here, Monu is a borrower who could buy his book by borrowing 1000 rupees from Sonu, and Sonu is a lender who could earn 100 rupees by lending 1000 rupees to Monu. Similarly, people invest their money in fixed deposits, PPF, that is public provident funds, bonds, etc., which are nothing but debt instruments. For example, if Mr. Ravi invested rupees 10,000 in a fixed deposit of SBI Bank at a fixed interest of 8% for 1 year, then Ravi is the lender, 10,000 rupees is the principal, SBI is the borrower, 8% is the interest and 1 year is the time. Here, FD of State Bank of India is a debt instrument. Like FDs, there are many other investment options which offer a fixed rate of interest. So, a debt mutual fund invests the investor's money in fixed income securities. Unlike equity fund, a debt mutual fund is considered less volatile because the maturity value of the debt securities in which the debt mutual fund invests is fixed. However, prior to maturity of such securities, there could be some volatility in the price of such instruments. The volatility in the debt funds depends upon the credit profile and the duration of the securities in which the debt fund invests. For example, a long-term debt fund will be more volatile than short-term debt fund. Now let us see some categories of debt instruments in which the debt mutual fund invests. A debt mutual fund can invest in central and state government rated securities, treasury bills, debentures, commercial papers, bank bonds, and certificate of deposits. Central and state government rated securities are the long-term instruments which are issued by government. Long-term instruments are those instruments which have a maturity of more than 1 year. And short-term instruments are those instruments which have a maturity of less than 1 year. So, treasury bills are short-term instruments which are issued by government. Similarly, debentures are long-term instruments which are issued by corporates and commercial papers are short-term instruments which are issued by corporate. Bank bonds and certificate of deposits are issued by banks. Bank bonds are long-term instruments and certificate of deposits are short-term instruments. Now let us see what are the different categories of debt funds. Debt funds can be classified in three categories on the basis of issuer, tenure, and on the basis of investment strategy. Now let us see these categories in detail. So let us start with on the basis of issuer. The first in the category is gilt funds. These funds invest in government securities only. For example, central or state government dated securities, treasury bills, etc. There can be short-term gilt funds or long-term gilt funds. Short-term gilt funds invest majorly in short-term securities of government, and long-term gilt funds invest majorly in long-term government securities. Since they invest in government securities, there is no risk of default. The second type of fund on the basis of issuer is corporate bond funds. Corporate sector bonds invest in securities issued by corporates. So, they can invest in bonds issued by banks, bond issued by PSU, that is public sector undertakings, and bond issued by private sector companies. The level of risk in such funds can be measured by credit rating assigned to the securities in which the fund invests. For example, there are credit rating agencies such as CRISIL, ICRA, who provide credit rating to these securities on the basis of their ability to repay. CRISIL's AAA rating represents highest level of security. Therefore, investment in a AAA rating bond would be considered a highly safe investment. For example, bond of HDFC Bank Limited bearing AAA rating will be safer than bond of Inox Air Product Limited bearing AA rating. And this bond would be safer than bond of Thomas Cook India Limited bearing AA minus rating. However, we should always note that higher the rating, lower will be the interest rate, and lower the rating, higher will be the interest rate. So your bond of HDFC Bank Limited will offer lower interest rate than Inox Air Product Bond and Thomas Cook India Bond. The next classification of debt fund is on the basis of tenure. The first in the category is liquid funds. Liquid funds, also known as money market schemes, invest in short-term debt instruments with a maturity up to 91 days only. So, if an investor wants to invest for 1 day or for a week or for a month, then liquid fund is a best option available for him. Liquid schemes are highly liquid and are considered less volatile because the securities in which they invest in have the lowest maturity. Liquid funds are generally compared with saving account. So, it is ideal replacement for money lying in saving bank accounts. In liquid fund, the securities having a maturity of more than 60 days need to be valued at market prices. That means they need to be marked to market. This concept we will study in coming chapters. Most of the liquid schemes keep their portfolio in debt securities of less than 60 days maturity, so that the securities are not valued at market prices. The second type of fund on the basis of tenure is short-term debt funds. These funds invest in both long-term debt securities and short-term debt securities. The benefit of short-term debt fund is they give better returns than liquid funds because the fund manager can invest in wider range of securities with higher maturity. The next type of debt fund is long-term debt funds. As the name suggests, these funds invest in debt instruments having higher term to maturity. That means this fund invests in those instruments which have a maturity of maybe 10 years, 15 years or 20 years. Due to higher maturity, these funds are more volatile than other categories of debt funds. Now let us move on to the other category of debt funds. The next category of debt fund is on the basis of investment strategy. The first fund in this category is diversified debt funds, also known as income funds. This is a very popular category of debt mutual funds. These funds invest in both government securities as well as non-government securities, long-term securities as well as short-term securities. Due to diversification across tenure and issuer, the returns are more consistent. The next fund on the basis of investment strategy is junk bond schemes. A junk bond scheme invests in debt instruments which have a lower credit rating. Due to lower credit rating, the securities offer higher interest rate. The objective of the fund manager is to generate higher returns for the investors. The next type of fund in this category is fixed maturity plans, also known as FMPs. FMPs are close-ended in nature and are issued for a fixed duration only. So, an investor in a FMP knows when the FMP is going to mature. It can be for 1 month, 3 months, 11 months or 2 years. In FMPs, the maturity of the investment portfolio is almost similar to the maturity of the scheme. For example, let us assume there is a 1-year FMP. Starting from 1st Jan 2017 and it will mature on 31st December 2017. So here, the fund manager will invest only in those securities whose maturity date is near 31st December 2017. Maybe around 25th December or 28th December or 30th December. As compared to FDs, FMPs may offer better return with risk being diversified into more than one insurer. That means instead of investing money in fixed deposits where there is only one issuer, investors can diversify their money by investing in FMP because there are multiple issuers. The next type of fund in this category is floating rate funds. As the name suggests, these funds invest in floating rate debt securities. Floating rate debt securities are those securities where interest rate is floating. That is, it gets changed at a fixed interval. Unlike other securities where the interest rate is fixed, in floating rate securities, the interest rate keeps on changing at a fixed interval. SEBI's categorization of debt funds. SEBI has categorized debt schemes under 2 categories. So let us first start with on the basis of investment duration. The first category is overnight fund. Under this category, the scheme will invest in debt securities which have a maturity of 1 day. In liquid fund category, the scheme will invest in debt securities which have a maturity up to 91 days. And in ultra short duration fund, the scheme will invest in securities which have a McCollish duration between 3 to 6 months. McCollish duration is also known as duration. It measures the weighted average time an investor will take to get all his invested money back in form of interest and principal repayment. We can also say that higher the duration, higher will be the volatility in the scheme. The next category is low duration fund. The scheme in this category will invest in those securities which have a McCollish duration between 6 to 12 months. The next category is money market fund. Here, the scheme will invest in debt securities which have a maturity up to 1 year, that is less than 1 year. In short duration fund, the scheme will invest in debt securities which have a McCollish duration between 1 to 3 years. The next category on the basis of investment duration is medium duration fund. The scheme under this category will invest in debt securities which have a McCollish duration between 3 to 4 years. However, the fund manager may reduce the McCollish duration between 1 year and 4 years in case of adverse situation. That is, situation where he has a view on interest rate movement which can affect the portfolio adversely. The next category is medium to long duration fund. The scheme under this category will invest in McCollish duration between 4 to 7 years, and under adverse situation the McCollish duration can be reduced between 1 to 7 years. The next category is long duration fund. The scheme will invest in securities which have a McCollish duration greater than 7 years, and in case of dynamic bond category, the scheme will invest in securities across durations. Now let us see the categorization done on the basis of investment in debt securities. The first category is corporate bond funds. In this category, the scheme will invest in AA plus and above rated corporate bond, and investment in these bonds will be minimum 80%. The next category is credit risk fund. In this category, the scheme will invest in AA and below rated corporate bonds, and minimum investment in these bonds will be 65%. The next category is banking and PSU fund. The scheme will invest in bonds of public sector undertaking, public financial institutions and municipal bonds. The minimum investment in this bond will be 80%. The next category is gilt fund. As the name suggests, the scheme will invest in government securities across maturity, and the minimum investment will be 80%. The next category is floater fund. In floater fund, the scheme will invest in floating rate instruments, and minimum investment in these instruments will be 65%.